Hi, and welcome to this second edition of What's Going On, a monthly podcast where I explain in essence what is happening in the Canadian economy in simple terms and in less than 5 minutes. There is one big news to cover today, which is obviously the fact that the Bank of Canada maintained the interest rates at 5%. What does it mean? What is the implication? We will dive into this. To start, this decision was anticipated by probably 99% of the people that were monitoring the situation. And the biggest message to keep in mind is that the Bank of Canada deems the current interest rates high enough and that they provide somewhat a satisfactory answer to current inflation levels. Let me give you just maybe a quick reminder of how interest rates work. So the process of increasing interest rate is also called quantitative tightening, or QT. You increase interest rates so people and companies can borrow less money or have to pay more interest on existing loans. So they cannot use their money on something else like buying more things. Therefore, this decreases the demand for goods and services, but also inflation. The trick is that there is always a lag, meaning that once you start increasing the interest rate, it will likely take 12 to 18 months before you actually see the full impact. Now, here's the big question for everybody. Is the 5% interest rate level enough to fight inflation? Because at the end of the day, yes, we do see some softening in the economy, but things are still going rather strong. And this is a hard question because unlike the previous economic downturns, you have a bunch of positive drivers in the economy that go against the effect of interest rates. And I will name a few so you have an idea of what it means. Let's say four of them. First, consumption, and more specifically, consumptions of immigrants. Every single person coming to Canada needs to buy at least essential products and services and pay rent, for instance. And the truth is that the flow of newcomers is not slowing down yet. It will, most likely, as very historically a slowdown in temporary workers during downturns, but it has not yet. So consumption is and will remain somewhat resilient. Now, if you look at the average consumption per capita, so per head, some will argue that it is true that it went down lately. Some people will say that it is because people can afford to buy less things, so they started to limit their spending. That may be partly true, but if you look at the need of a long-established suburban Canadian who needs to buy a new lawnmower, who will splurge on Christmas decoration in Costco, it is drastically different from a newcomer who is likely a student or a temporary worker who just needs some basic furniture from IKEA. So if you look at the consumption per head, it will decrease since within the mix of people, we added a lot of people who have a propensity to buy less things in general. But it is difficult to say what really comes from higher interest rates versus the change in the mix of people, and it is probably a combination of both. Secondly, the price of oil. The Canadian economy has a solid chunk that is propelled by the oil and gas business, about 7-8% give or take. And while there are concerns about the global demand of oil due to a general slowdown, the supply was also cut by the oil producing countries to try to keep prices from crashing. Because if demand slows down, but there is also less supply, then prices should remain somewhat afloat, right? And it worked at least to some extent. If we have a look at the September trade balance in Canada, exports increased by 2.7%. And if we focus just on energy products, we saw an increase of 10.6%, which is not due to more volume, but higher prices. So if you take exports minus imports, we brought home about $2 billion of trade surplus in just 1 month, right? It is true that oil prices are starting to drop a bit. They still remain high, and this will be very favorable to the economy, especially in provinces like Alberta. Therefore, again, more money injection and persistent inflation. The third big one I mentioned last month is wage growth. And I mentioned it lately on my LinkedIn account, but historically, when you have periods of high inflation, you also have more labor strikes. And the Quebec government workers' strike of this week is a good example of where it is headed. Remember, 30% of the Canadian workforce is unionized, and their wages have grown more slowly than the rest of the market lately. So it just makes sense that there is more negotiation to bring the wages higher. But by doing so, you inject even more money into the economy, which is technically not what we want as we're fighting high inflation. So wage growth is technically something that will be challenging in a context of taming inflation, especially because it is already currently outpacing inflation. And last but not least, maybe a quick word on the labor market. The unemployment rate has finally ticked up after staying flat for 2 or 3 months. We were stable at 5.5%, but it went up to 5.7% in October. But here's the catch. Although not much, we're still creating jobs. About 18,000 additional jobs in October were created. So what does it mean? On a quantitative point of view, it means more salaries paid and therefore technically more money in circulation again. But the unemployment rate increased. This simply means the labor market could not absorb all the new workers, mostly newcomers, which kind of makes sense since integration of immigrants to the labor market remains a solid challenge for Canada. But overall, the one thing to remember is that there is still some job creation. So to make it short, you have on one hand interest rates that are quite high, but on the other hand, you know that some positive things are still bolstering the Canadian economic resilience. And the result of that is that we have a Canadian economy that is somewhat stagnating. And while we know it is slowing down, the big question that we are still asking ourselves since January is, will it slow down fast enough to tame inflation? And going back to our QT process, right now the consensus is that interest rates will be decreased by April of next year. Will inflation be in control then? Probably not. But remember that for interest rates to have a full effect, we have to wait 12 to 18 months, meaning that we start decreasing the interest rates in April of 2024 because we expect inflation to be under control somewhere in the second half of 2025. That is the consensus, but whether it will happen or not is still a big unknown. And given all those positive elements that I mentioned, and there are others, I truly think that April may still be too soon. And one proof of that, when the Bank of Canada said they would not increase interest rates at this time, they were very cautious for once and mentioned that, well, the door was still open if those positive drivers were persisting.